Welcome and thank you for joining today's 504 Debt Refinance Without Expansion webinar. Please note that all participant lines will be muted until the Q&A portion of the call. We will provide you with instructions on how to ask a verbal question at that time. You're welcome to submit written questions during the presentation, and these will be addressed during Q&A. To send a note, select All Panelists on the Send To drop-down menu of the chat panel located on the lower right-hand side of your screen. If you require technical assistance, send a note to the event producer or call our help desk at 888-796-6118. With that, I'll turn the call over to Linda Riley, Chief of the 504 Program. Please go ahead.
Thank you so much. Hello, everyone. Welcome from Washington, and also, too, welcome from the staff from the Sacramento Loan Processing Center. Ian Nguyen and his team are joining us also today as presenters, so thanks, everyone, for joining us. We're here to talk about the 504 Debt Refinancing Program that was reauthorized for $7.5 billion annually, and the latest change that we have is the final rule that was published on June 6th. So many of you have been somewhat familiar with the program as it's evolved, and so we're going to talk about what's changed, what stayed the same, and we're going to go over some deal examples. Next slide. On the 504 fees, we're going to be seeing the level of activity will determine whether or not we stay on subsidy or not in the 504 program, and that we have to have zero subsidy for any year for the 504 debt refinancing program to be offered. And we have the supplemental fee for the refinancing program, and the fee update for FY18 is 68.2 basis points. So that was announced at the beginning of the fiscal year. We are looking at seeing debt refinance for FY19, so we'll be publishing the update of the fee in September. So this is the fee until September, so we'll be sharing updates as they're available. Next slide. So I'd like to talk about the team that's going to be presenting on the call today. We have some new team members here at headquarters, and we also have some very experienced team members from Sacramento. The final rule changes that we're going to talk about today, which is the changes are the majority of the webinar and the deal structure, but we'll also do just a refresher for people about what hasn't changed. So let me talk about the staff first, and then we'll talk about the agenda second. So here at headquarters, Warren Boyd, myself, and Erica and I, we're on the team that's working on some other initiatives. So the main presenters today are going to be Babak Hassani and Ginger Allen. They're the underwriters that work in the 504 section in OFA, and also to the Sacramento Loan Processing team. Ian Nguyen is the director of the SLPC. He and his team will be working on processing the loans and helping answer questions through the eligibility checklist, as well as Babak and Ginger will be helping as follow-up for today's webinar. So David Miller will be doing the case examples from the SLPC, and so we'll be turning it over to each of those presenters to go more in detail. So the main changes that we're talking about on the final rule are the changes in qualified debt, currency on all payments due, refinancing projects with limited or special purpose. We did have a change on eligible business expenses on documentation, so we'll be talking about that. And then the forms changed a little bit, so we'll be going over the forms changes. So I'd like to start it off today by turning it over to Babak Hassani.
Thank you, Linda. Good afternoon, everyone. Thanks for joining our call. As Linda mentioned, we had 5 major changes that actually happened in the final rule. The first one that we're going to talk about is the qualified debt. It's, you guys are probably going to be thrilled about this, at least I was, and we are here at the headquarters, is that qualified debt, if the loan was refinanced, if the loan that you're going to be refinancing was refinanced within the last 2 years, that is that's now qualified, where previously it was not. And these loans, they cannot, of course, have had additional proceeds been added to it, but if the loan was refinanced within 2 years, now it's allowed to be used into this into the project. Next slide, please.
So we've received many questions about the final rule changes, and one of the questions that we received a few times is with regard to documentation. Specifically, people are curious about what documentation must be provided to show eligibility as qualified debt when the refinancing's been done within the 2-year period. And we have good news for you there. CDCs only have to submit loan and lien instruments for the most recent loan and the loan that was taken out by the most recent loan. Together, those documents have to demonstrate that the effect of the most recent loan was to extend the prior loan's maturity date without advancing any additional funds other than for covering closing costs.
The second item that was updated for the final rule is in regards to the currency on all payments too. We are now allowing for loans that have been modified or refinanced within the past year to be allowed into this. However, there's some items that these loans have to actually there's some requirements that these loans actually have to follow, and that would be, of course, the purpose was only to extend the maturity date. So if a loan was modified, the modification can only be for if the loan was extended. It cannot be if any additional proceeds were added to that loan. It can only be if the loan was extended. So if we have a loan that had changes to owners or an additional payment that was added to it, or I'm sorry, additional proceeds were added to it, that would not be allowed. However, if it was only to extend it, now it's allowed into this process.
The third area of change is with regard to equity contributions. Specifically, when the eligible fixed assets serving as collateral are either limited or special purposes, then the borrower must contribute at least 15% toward the refinancing project. However, if there's an economic recession, we can publish a notice in the Federal Register and lower the minimum borrower contribution to 10%. And the recession would have to be determined by the National Bureau of Economic Research. And then, of course, once we've recovered from the recession, we'll publish another notice in the Federal Register that we're going back to the 15% borrower contribution level.
The fourth item that was changed is in regards to eligible business expenses. We're also calling this EBE, eligible business expenses, aka would be the cash out portion. The only change to this was that the amount is now at 20% of the fair market value of the fixed asset. No other changes happened to this. Basically, it's still at an 85% LTV. No additional collateral can be added if there is a shortfall in the appraisal. That is only, of course, if you're utilizing the eligible business expenses, aka the cash out portion.
Eligible business expenses are limited to operating expenses, and they have to have been incurred but not paid prior to the date of application or that will become due within 18 months. This includes any operating expenses that can be deducted as an expense in the taxable year in which it was paid or incurred. On the other hand, capital expenditures, such as expenditures for expansion and acquisition, are expressly ineligible. A good way to think of it is this way. If the borrower can itemize the expense on their income statement, it's probably going to be eligible. But if they can capitalize it as an asset on their balance sheet, then it's definitely not eligible.
More on the eligible business expenses. This part goes over that, which is common sense basically, that the debt or the expense must be a business expense. So if it was a business credit card, it can be used. Of course, the the expense has to have been incurred but not paid. And that's the key part here. If it was paid, we cannot go back in time and have that be included, but it must be for debt that was incurred. Also, the borrower and the CDC must certify this. CDC can document this to certify that this is an eligible debt in the credit memorandum. And one thing to note also is that the CDC should and must, they must itemize the eligible expenses and state what these expenses are for or will be for in the next 18 months.
As Babak said, both the CDC and the borrower have to certify in the application that the funds will be used to cover eligible business expenses. One thing to note is after loan closing, the SBA may ask the borrower to provide substantiation that they actually use the funds provided for eligible business expenses. And some of the things that a borrower might provide to substantiate that would be bank statements, invoices marked paid, cleared checks, things along those lines. The key takeaway here is that loan proceeds can never be used to refinance any personal expenses.
We had a bunch of questions that came in, but this was one of the common ones that we've been seeing is, the question is, what is the documentation requirement for the eligible business expenses? Is a gross figure acceptable or must expenses be itemized? So basically the CDC must document the nature of the eligible business expense, and it has to be itemized in the credit memorandum, along with the CDC certifying that this is, in fact, an eligible expense, and the eligible expense would be in the SOP. We actually cover that, what those expenses are. At application, of course, the borrower must just, how the borrower actually certifies is on the application in 1244. How the TPL certifies is the TPL should put this in the commitment letter stating that this is an eligible expense, and the eligible business expense documentation must be retained at the CDC in case SBA or OCRM ever requests it.
The last major area of change in the final rule is that we updated the disbursement period. Prior to the final rule, we had 6 months to disperse funds. Now we're extending that to a total to 9 months to disperse funds. However, if you have good cause, you can request an exception to policy for an additional 6 months beyond that. So if you do receive an exception to policy, you can have a total of 15 months for your disbursement period.
The remainder, or the rest of this PowerPoint will be actually on items, of course, not talking about the examples that David's going to cover, but we're going to be going over items that did not change in the final rule. And keep in mind, the final rule goes into effect on June 6th. So the changes that we previously just spoke about will be in effect as of next Wednesday.
So on January 1st of this year, SOP 5010-5J became effective. And when that became effective, we rolled up 2 prior policy notices into the current SOP. The first policy notice was 5,013.82, which was effective in May of 2016, and that was the reauthorization of the 504 debt refi program. And then the second policy notice was 5,019.39, which was effective November of 2016, and that was enacting changes to the 504 debt refi program. There were 5 major changes in that policy notice. The first was eligibility of new businesses, loan to value for financing of business operating expenses, appraisals, and that they have to be submitted with loan approval and may be dated within 1 year of loan approval. The option to use interim loan or escrow accounts for the same institution debt, and it also issued guidance for waiving requirement of 50% rule for CDC's new financing.
Now, the 3 statutory requirements are, of course, the 504 program must be at 0 subsidy. 2, the CDC limitations on the refinance, this is the 50% requirement. And, of course, number 3, the 504 alternative job goal that was previously allowed on the Jobs Act is eliminated here. We'll talk more about this in the next few slides.
Yeah, and we've already received a few questions about these statutory requirements. The thing about a statutory requirement is that they can't be waived, and we can't receive exceptions to policies on something that's a statutory requirement. So the first one here is the zero subsidy requirement, and that states that both the debt refinancing program and the regular 504 loan program have to be operating at a zero subsidy in order for the debt refinancing program to be effective in that fiscal year.
The 50% limit prior fiscal year CDC dollars loaned, or in parentheses we put this as approved because we've gotten this question many times, is what does loan mean? So any applications that have been approved count towards this 50%. Congress has authorized waivers on these, and the waivers must be submitted via E-Tran to SLPC for consideration. Of course, with the waiver, you'd want to, well, I'm actually jumping ahead of myself. We do talk about the good cause in the next few slides.
That's right. You're stealing my thunder, Babak. So the waiver guidance is on page 300 of the current SOP. When we look at giving a waiver, one of the things that we're going to do is we're going to focus our determination only on the borrower's financing needs and not on the circumstances of the CDC. And we can issue a waiver depending on whether the borrower has access to other sources of financing, including other CDCs, and whether the CDC has an existing loan with the borrower that is in current status.
In regards to the job creation and retention, of course, the CDC has to adhere to the 504 loan program job creation and retention requirements. However, if the CDC meets their total job banks requirement, so you meet your own job banks, you can apply one of the public policy goals with the exception of the energy efficiency. That one is not allowed in the 504 debt refinancing without expansion program.
Some other application documentation requirements. For appraisals, they're not required at the time of application, but they are required prior to loan closing. We encourage you to get them done as soon as possible in the process so that you can restructure the loan if needed based on the appraisal. They must be dated within 12 months of the date of application, and they must comply with the requirements set forth in the SOP. As far as transcripts and lien verification, I think you'll find this is good news. Nothing has changed for the requirements for either transcripts or lien verifications.
PCLP lenders still have to adhere to submitting all applications for the 504 debt refinancing without expansion program to SLPC. So whether you're a PCLP lender or your regular CDC, you still have to submit all applications to SLPC for consideration.
Occupancy requirements. Borrowers for the 504 debt refi program still have to meet all the current 504 loan program occupancy requirements at the time of application. So they have the same occupancy requirements.
The next couple of slides, we're going to go over the couple of forms that actually were changed. The first one would be the 1244 updates. 1244, at time of application, of course, the borrower and the CDC certified that the debt is eligible. As we noted before, the third-party lender certifies this in the commitment letter, and the loan documents and lien instruments required under 1244 must be submitted to SBA as part of the application.
And the Form 2234C was also updated. It was revised to address the eligible business expenses and also for the minimum borrower contribution and third-party lender loan size.
Next, we have the examples that David Miller will be covering in regards to how to structure some of the 504 refinance.
Thank you, Babak, and welcome everybody on the webinar. My name is David Miller. I oversee the original processing of all of these debt refinance loans, as well as the servicing that we do here at Sacramento for all of these loans as well as all the regular 504 loans. Now, we've gone over a lot of the changes, and we could essentially have an infinite number of examples because there's an infinite number of variations of combinations of things. So we've limited the examples to 5 in the interest of time and sanity. So we'll go through these 5, and obviously we're going to touch on a lot of the points and the changes and what the deals look like. These are the types of deals we see coming through on a regular basis and some of the combinations that you may encounter as you're out in the field and dealing with the borrowers. So if we can go to the first example, next slide, please. Basic one. I mean, these are simple. We'd all love to see a lot of these. This would be a refinance of a $100,000 first mortgage or deed of trust, depending on where you might be, plus a $400,000 second mortgage that was borrowed for property renovations. So in this example, we're looking at 2 loans. We're both going to be deemed as qualified debts. And the appraised value of the property is $1 million. So the structure of this would look similar to what's in the green box on the right. You have an appraised value, which for a debt refinance loan is our project cost. Again, we kind of work backwards on these because we don't have a project cost, so to speak, so we've deemed the appraised value of the property that we're looking at as the project cost. So we have 2 qualified debts that we need to pay off. That's the request for financing. So we have a total loan proceeds. We need to give this borrower $500,000. How do we get there? One way, an acceptable structure obviously would be the third-party lender at $250,000, the SBA 504 loan at $250,000, and the borrower's equity contribution in this case would be $500,000. There's no need for cash out of the borrower's pocket. The equity they currently have in the as-is value of the property is more than sufficient to cover the required injection. So this would just be a simple, fairly straightforward debt refinance. And the structure on the right, the third-party lender and 504 loan can be equal. The only caveat there is the third-party loan cannot be less than the 504 share. So we'll start out very simple one, and we'll move into a little more complex. So let's go to the next slide, if we would. So here we have a request to refinance $300,000 of existing qualified debt, plus $400,000 for a business line of credit and other eligible business expenses, those EBEs that we've been talking about. Again, property is appraised at $1 million. So what would this project look like, and do any of the limitations or things come into play here? Well, the answer to that question is yes, they do. So let's start at the top again in the green box. We have the refinance project. That's the appraised value, $1 million. That didn't change. We have a qualified debt of $300,000. That's completely eligible. But the eligible business expenses, those EBEs, those are limited to 20% of the project. So the request was for $400,000, but only $200,000 are eligible under the guidelines of the program. So the structure, again, would look very similar to the first one. We have a total financing need. The small business concern needs $500,000. They actually wanted more than that, but under the guidelines, they're eligible for $5. So the third-party lender could come in again and partner with us at $250,000. The SBA 504 loan could be at $250,000. And again, the equity contribution, that equity that's currently in the property, serves to cover the borrower's injection, and therefore this can be done with no cash out of pocket from the borrower. The equity in the property stands good for their contribution. The limiting factor, obviously, in this example is the eligible business expenses are limited to 20% of the project amount. So in this case, that limitation is $200,000. The secondary limitation is that we can't go over 85% loan to value. Well, we're certainly well under that in this example. So that limitation doesn't come into play, but the 20% of the project amount does. So this would be an acceptable structure that we could do this deal with. So let's move on to something a little more complex. So here's an example, and if you've been through these before when we introduced and then reintroduced the project, what do you do with a property that's underwater? It's over-encumbered. Now, thankfully, as the markets across the country have rebounded from the depths of the recession, we're seeing less and less of these, but occasionally one comes through. So, again, we have $1 million property, and there are 3 loans on the property, all of them used for the purchase, building, and renovation of the fixed assets. So we've got $1,250,000 on a property valued at $1 million. Is there anything that can be done? Well, the answer is yes, and we actually have 2 different possibilities. If we're not going to add any additional eligible fixed assets, we could go with structure number 1. What does that require? It requires some money. It requires that cash be brought in to pay down those mortgages to the 90% loan to value. And we can go to 90% because we're not doing any of the EBEs, those eligible business expenses, so we can go all the way up to 90%. So if they do have cash now and they would like to refinance and take advantage of fixed rates on a 504, et cetera, they can do that. And we would have a qualified debt of $900,000, TPL at $500, SBA at $40, the borrower's equity at $100,000. The typical 50-40-10 eligibility structure that we normally see on a regular 504 loan. The second way to do it is if the borrower doesn't have the cash to put into the project or chooses to pledge other eligible fixed assets, then they can do that and raise that refinancing project up to $1,389,000 or some other number in order to get the qualified debt, which the $1,250 is all qualified, in order to get that within that 90% range. Again, we're kind of backing into the numbers there, but we allow them, if they're not taking cash out, they're not doing the EBEs, we allow them to pledge other equity and other eligible fixed assets to meet the financing requirement. So in this case, just to make it simple, we brought it up so again we have the 50-40-10 structure that you see on the bottom. So there are 2 ways to do it. They can pledge equity and additional fixed assets, or they can actually bring cash to the closing table, pay off or pay down some of the liens that are on the property, and close it with a regular 50-40-10 at the appraised value. Either one of those will work. And as we go on now to the next one would be fine. Thank you very much. Here's something new. Refinance $800,000 qualified debt on a bowling alley. Property is appraised for $1 million. So I would imagine most people out there would understand that a bowling alley is on the list of things that are special purpose. So we've now identified what is necessary in order to refinance a special purpose property. So we have a qualified debt of $800,000. We have $1 million piece of property. So again, the borrower needs $800,000. Can we get them $800,000 and still meet the program guidelines? Well, the answer to that question is yes, you can. So the borrower's contribution on a special purpose property must be at least 15%. The additional equity, the borrower has 20% equity in this case. That additional equity can be applied to either the 504 loan or the third-party lender loan. In this case, I've chosen to show the example where that additional equity was applied to the third-party lender loan, therefore maximizing the eligibility on the 504 and the fixed rate. So we'd have $450 at the TPL, and we would have $350 at the 504, and the borrower's equity contribution of $200 is 20%, so we meet the 15% requirement. They're in excess of that. So in this example, you can refinance a special purpose property, and the third-party lender for the debt refinance, if there is equity above the 15%, this is the difference. That equity that's above the 15% can be used to reduce the TPL's portion of the project The caveat, again, is the TPL has to be equal to or greater than the 504 share, but you do have some leniency there to allocate that extra equity to wherever the applicant would like that equity to go, either to borrow less from the TPL or potentially borrow less from the 504, whichever they would prefer. So let's move on to the final one here, and we've thrown a couple things into this one. Refinance a $700,000 mortgage debt originally taken out 5 years ago, refinanced 10 months ago. This is a big change. Before, this would not have been eligible. That refinance would have deemed this ineligible. But now with the change that Babak and Ginger went over earlier, we've now made this a potentially eligible deal. So they want to do $700,000, and they also want $200,000 for those EBEs, again, those eligible business expenses. And the property is worth $1 million. So where do we go from here? Well, our project, again, is $1 million. We have a qualified debt of $700,000. Eligible business expenses. Well, they want $200,000, and we've got $150,000 in there. The reason that we have $150,000 in there is we've bumped up against the limitation of 85% loan to value. So we can't go above 85% loan to value, so we can't give them the full $200,000 that they would like. So what have we done? We put in $150,000, so the total loan proceeds are $850,000. In this case, in order to get the maximum, the third-party loan would have to be at 50%. SBA would be at 35% or $350,000, and the borrower's equity is $150,000 or 15%. So we've met the guidelines. The EBEs are not more than 20%. In this case, they're 15%, and the borrower's contribution is at least 15%. Because we're dealing with a special purpose property, which is in this case a car wash. So it can be structured. We can't get them everything that they want, but we can cover the vast majority of their needs and still make the deal work under the new expanded guidelines of the program. And we could have done more and more and more examples. Again, there's an infinite number of these types of examples that we see on a daily basis, but those should give you a little bit of what we see here in regards to the debt refinance and how it actually applies in the real world on structuring deals. And I think go to the next slide. And we'll hand it back to Ginger. Thank you very much.
All right, thanks, David. So we realize it can be confusing to have different requirements for the debt refinance without expansion program versus the debt refi with expansion that's eligible in accordance with the regular 504 loan program. So we thought it would be helpful to set up a table comparing side by side some of the major differences between the two programs. Obviously, what we've been talking about this afternoon is the column on the left, which is the debt refinance without expansion. So starting in that column, the top row, one thing that's unique to that program is that the maximum borrow contribution required is 15%, unless SBA or the lender or the CDC determines they need to require more as a risk mitigation measure. Whereas in the debt refi with expansion, the maximum borrower contribution required is 20%. In the without expansion program, federally guaranteed loans are not eligible. We've already received several inquiries about that. So just that is a distinction. Federally guaranteed loans are eligible for refinance in the debt refi with expansion, but not in the without expansion program. In the without expansion program, third-party lender loans can be reduced to less than 50% of the project cost as long as the third-party loan is equal to or greater than the SBA loan. Whereas under the debt refi with expansion program, the third-party loan must always be at least equal to 50% of the project cost. It can't be reduced. Both programs require that the borrower's contribution be adjusted if they're special use or limited assets acting as collateral. The debt refi without expansion program comes with a supplemental annual fee of 40 basis points. So the current total annual fee for that program is 0.682%, whereas the debt refi without expansions program is at 0.642%.
The other slides, okay, mine advanced too. The other slide is, so without expansion, eligible business expense, or AKA cash out, is at a maximum of 20% of the appraised value. I noticed that that was one of the questions that came up as well. Of course, the LTV is maxed out at 85%, and you cannot pledge additional collateral. With refi with expansion, there is absolutely no cash out included in this. Refi without expansion, of course, the loan has to be, or the borrower has to be in business for at least 2 years. The loan has to have been in existence for at least 2 years. So age of the original eligible debt, time debt secured by the same eligible asset, and time applicant is in business. So all of those have to be in place. Refi with expansion does not have this requirement. Of course, the requirement that they have is that the debt has to meet the substantial benefit test. The next item is refi without expansion. Borrower must be current on all payments. This is also a requirement in refi with expansion. However, refi without expansion now allows for loans to have been modified or refinanced within a year if no additional proceeds were added to the loan, and of course, the only change that was done in the modification was the maturity date was extended. So that's allowed in the refi without expansion. Both programs, of course, both refi without and with, the borrower has to have been current within the last year.
We've been asked whether the agency has considered revising the current structure to once again permit other secured debt, and the answer is no. That category was eliminated in the eligible business expenses, so now we're just going with the business operating expenses, which is now referred to as simply eligible business expenses.
A common question that has come up is, the purpose of the refinance is for a partner buyout. Is this eligible? Of course, this depends on the circumstance, and if the borrower meets the requirements of if the applicant meets the requirements in the SOP, and I think it's on page 256 for new business, then the borrower has to include an additional 5% because now it's considered a new business. However, if this borrower is being removed, is not a key personnel, is not a decision maker, is not someone that they heavily rely on for marketing and sales, then you can make an argument in your credit memorandum that it's not considered new business. But one thing I would recommend is that if you do have a partner buyout for a refi, you should address all those matters from page 256 under the description of new business. You should actually address the section that states if it's a new business ownership, if it's unproven, and if there's an unrelated debt that's not part of the business operations.
We've also received a few questions about collateral. If the fair market value of the collateral will not support the refinance, how can the borrower address the collateral shortage? And it depends on the circumstances. Regardless, the collateral for the most recent loan must include, at a minimum, the same eligible fixed assets that served as collateral for the prior loan. If we don't have any EBE, if there's no cash out eligible business expenses, then the options will include adding eligible collateral and or adding subordinated debt as long as it meets the criteria for borrowed equity per the SOP. In other words, it has to demonstrate repayment ability and it can't be repaid faster than 504 loan, et cetera. But if the refinancing project includes the financing of EBE, the 504 loan and the third-party loan together can't be any more than 85% of the fair market value of the fixed assets that will serve as collateral. And note that this is in bold. With EBE, the borrower may not increase the value of the refinancing project by adding any additional assets as collateral.
And the last question that we have is, my borrower's loan will mature in 3 weeks. The borrower will not be able to come into the office. If we provide an extension, would this be considered a loan modification that would mean the debt is ineligible? The lender must provide, of course, the extension, and the extension has to have gone through at the time or prior to the application date, would be prior to SLPC receiving the application. It can't be that the loan has matured and the application is sent to Sacramento and there's a note that states that there will be an extension. That's not allowed. The extension has to have happened in order for this to be an eligible case. And of course, as we spoke about it previously, the only item that's allowed for the extension or for this modification is that the maturity date of the loan has to have been extended. No other changes is allowed in the modification for an extension.
So now we have Q&A.
So we do have some questions that have come in through the Q&A, but just a couple of things before we start. And Babak's looking at the questions that have come in. We have a questions box, the 504 refi questions box that is monitored by David and Babak and Ginger. So feel free to send in your questions there after today. We're looking through a few questions. A lot of repetitive questions come in, so Babak's trying to get a sense of some of the questions that you have for us today. And just also Q&A, we've got some other upcoming events that we'd like to share with you about as well.
So some of the questions that we got was, will these slides be available? Yes, we will be providing the slides to or once we get it from a moderator, we'll actually end up providing it out to the industry. I believe, in 3 business days, Linda? Yeah, in about 3 business days you should have the slides. One of the first questions that we had was, I recently had a debt refi request declined due to an extension. This is in regards to a note that had expired, but then the borrower was able to get an extension. Yes, you can resubmit that, of course, if the extension has gone through, and of course it meets all the requirements. You can go ahead and resubmit that. So basically, what the question is that the notes had expired or had matured, but then no extension was given. Now there's an extension. Can they, as long as, of course, they meet the currency requirements and they meet the extension requirements?
So I wanted to add on to what Babak was saying about the 3 business days. This entire webinar is being recorded. So within 3 business days, we're going to receive a link to the recorded webinar, and we can send that out via email to all of the attendees. Just bear in mind that link will only be good for 7 days, after which time it will expire. So if you have anyone who you wanted to share this with, pass along that information to them as well. So we'll be sending out a post-webinar follow-up with that link, as well as the PowerPoint presentation.
Thanks, Ginger. One of the other questions that we have is the CDC responsible to track the use of the EBE for the 18 months, or is SBA going to spot check? No, the CDC is not responsible to track it for the rest of the 18 months. However, the CDC is responsible to notate and itemize it, excuse me, specifically in the credit memorandum, what these items will be for, and of course, have some sort of mitigating factors or show proof of how these will be used. But but no, not to track it for the next 18 months. Of course, if you can get that information, that would be great, because if SBA does request it, it would be a lot easier for you and your borrower once SBA does require the spot check. Next question. Does the new 9-month to close time limit apply to previously loans approved? No, it does not.
It's effective as of June 6th.
Yes. Can we receive copies of the slides? Yes. Sorry, just bear with me. I'm just going through the questions. A lot of them are just redundant. Marvin, do we have any hands raised to see if we have any other questions while I skim through the written questions?
Okay, so I'll go ahead and actually give the instructions for those who wish to ask a verbal question. So ladies and gentlemen, as we move to Q&A, please feel free to place yourself into the question queue by pressing #2 on your telephone keypad. You'll hear a notification when your line is unmuted. At that time, please state your name and question. Once again, that's #2 on your telephone keypad if you have a question at this time. And we do have a question coming in here. I'll go to the first question. Caller, your line is unmuted.
Hi, this is Dane with Regional Loan Corporation. Calling about when I'm submitting an application that includes refinancing with expansion, do I go on eScreen, select the SBA 504 refinancing program, or do I submit it as an SBA 504 basic?
David?
Refinance with expansion would be an SBA 504 basic. The refinance one in there is for the standalone debt refinance, to the best of my understanding.
Okay, so I guess what's the difference with the SBA refinancing, SBA 504 refinancing program with expansion? So when do we actually use that, I guess, the 504 refinancing program on E-Tran? It's just...
Well, the 504 refinance program would be for the standalone non-expansion refinance. The other would be submitted as a regular 504 because the expansion refinance is part of that program.
And David, if I can add on, there's not a supplemental fee that has to be charged for the refi with expansion. That's why you don't have to identify it separately. There is an additional supplemental fee required for refinance without expansion. That's why you have to specifically identify it in E-Tran.
Okay. Thank you very much.
All right, we'll go ahead and move to the next question. Caller, your line is unmuted.
Hi, it's Ray Graves in Cleveland, SBA. If you could you clarify a little bit on the definition of eligible business expenses? In particular, I thought that I heard you say that it had to be future expenses, but then in the examples it seemed pretty clear that we also want it to be used for line of credit, and in the last example there was some reference to some expenses being incurred in the future, which implies that some were incurred in the past. So just please clarify what the definition of EBE is.
So the definition of EBE is basically the same as it was previously. It really hasn't changed at all. This is based on policy notice 501382 that came out in 2016. Basically, if the expense cannot have been paid for, it could only be for expenses that will be incurred. So some of the examples that we had in the policy notice that's now in the SOPJ is salaries, utilities, whatever actually shows on the income statement. Those can be included. Of course, we did speak about lines of credit or business credit cards. Those debts cannot have been paid. I did notice a question that came in and said, how do you put a line of credit since those are paid? If it's paid, it cannot have been used it cannot be included into this debt. So it's basically only for debts that are incurred that will show up but not paid for. Of course, I think one of the other items that we...
David Miller, could you help clarify that as well, maybe?
Well, yeah, in the examples, when we were talking about a line of credit, that would be a dollar amount that is still outstanding on a business line of credit, a bill that has not been paid. So that's where that comes in. And eligible business expenses, obviously, are something that's accrued but hasn't paid at the time of application, or something that is going to accrue over the next 18 months, so you can project into the future for some of those things and ask for an allotment or an allocation to go towards those eligible future expenses. But in the example, when I say a business line of credit, it means there's that much money out, it's currently outstanding to be paid on that line of credit.
Okay, thanks.
Okay, we'll go ahead and move to the next caller. Caller, your line is unmuted.
I'm good. That's okay. My question is answered. Thank you.
All right, thank you. And we'll move to the next question. Caller, your line is unmuted.
Hi, this is Ahmad from Advantage CDC. So the line of credit, if it has an outstanding balance, will that be considered as part of EBE, or will that be considered as part of the qualified debt refinance?
Business line of credit would be part of the EBE. It's listed under as an eligible business expense, so it would be part of that calculation.
So it could be so it could be a line of credit, and if there is room, then we can add a little more operating expenses, but it will all be considered as EBE actually. Okay, thank you.
All right, and we do have another question here. Caller, your line is unmuted.
Hi there, this is Mandy Crookhausen with KeyBank. And I just wanted to clarify on the Refinance with Expansion program. I've got the current SOP in front of me now, and it says, or it indicates that any amount of existing indebtedness that does not exceed 50% of the cost of the expansion may be refinanced. And I didn't notice that in the compare and contrast of the two different refi programs, and so I was wondering, did that requirement on the Refinance with Expansion program go away? Does that question make sense?
Yes, it did. No, sir, that requirement has not gone away. The Refinance with Expansion still requires the expansion portion to it, so that still stays. Thanks for bringing that up, actually.
Yeah, no sweat. I'm glad that it's still there. Make sure I've got it down pat. Thanks.
Yeah, thank you.
Right, and I am currently seeing no further questions in the verbal phone queue.
Well, that's good. Any questions?
We have a few more questions, which we will, and there's a few more coming in. So we'll actually go through them, and we will disperse them out when we do send out the PowerPoints to everyone as well.
So terrific job for the presenters on today's call. Once again, Babak Hostani, Ginger Allen, David Miller, fantastic job all of you did today. The fact that we had minimal questions shows what a terrific job you did in preparing these materials. And I know that the follow-up questions and doing the deals is really that interaction after this webinar where people are really going to appreciate all of your time and attention even more. So I still want to give a great shout out to Ian Nguyen and his team at the SLPC. They do a fantastic job with the eligibility mailbox, supporting the 504 Debt Refi Initiative. They do a job, so hats off to Ian and your team for all you do every day to help us serve our small business customers as well as work with our CDCs and our bank partners and our LRS. So we did want to give a commercial. We do have another 504 Connect call coming up June 5th from 3 to 4 p.m. It's going to be more geared toward our lenders, but we're going to be talking about the SOP updates, the 25-year debenture, as well as debt refi, and just trying to answer general lender questions about what's coming up in the horizon for 504. So thanks, everyone, for your participation today. Thanks for all you do always to support 504 and the 504 Debt Refinancing Initiative. Thanks very much, and from Washington, D.C. and from Sacramento, California, have a fantastic week.
Thank you for joining today's conference. The session is now concluded, and you may disconnect.